In its latest monetary policy statement, the central bank projects inflation to continue rising from the current 7.2% up to between 8 to 10% over the next 6 months due to, among others, a sharp loss of the shilling's value and the rise in food inflation as a result of the projected El Nino weather impact. This, it says, is the reason it's moving up its benchmark rate by a percentage point, stressing that similar moves in the past have helped keep inflation under check.
The monetary policy actions taken by the Bank of Uganda since April 2015, which have contained a rise in which have entailed a rise in the central bank rate by 5 percentage points, have already dampened inflationary pressures and reduced the risks to high inflation.
The move is expected to trigger commercial bank interest rate increases, which will dampen credit demand, the amount of money in circulation, and by extension, economic activity. Most commercial bank interest rates have been steadily moving up in the last 12 months in response to the central bank's previous policy rate moves. The central bank rate has steadily increased from 11% in January, touching 16% in August, before today's 17% peak. In response, commercial banks have steadily moved up their lending rates from an average of 21.5% in January, touching highs of 23.7% in March, today hovering at 27%. While inflation will be under check, the ultimate cost of the central bank's monetary tightening policy will be suppressed economic growth due to the resultant high cost of credit.
To ensure that medium-term inflation converges towards the Bank of Uganda policy target of 5%, a further monetary policy tightening is warranted.
Already, the bank has revised down the GDP growth to 5% from 5.8%, with the situation being made worse by tough external economic factors including reduced export demand and reduced capital inflows. Ingrid Nantege, NTV Business.